Well, hello, and welcome back to Principles of Accounting 2. Still your host, Dr. B, and I'm still alive, so we're still doing this. I appreciate your patience over the past 2 weeks. The 2 weeks ago was on at a conference, and then of course the next week I get sick. So, or maybe it was the other way around. I don't remember. So I apologize for being absent for the past 2 weeks. That was not planned, of course. So I sincerely apologize for that. The good news is we had those videos ready to go, which hopefully you found helpful. Uh, so again, sincerely apologize to all of you for missing the past 2 weeks. But I'm glad to see that you all maintained the momentum, you marched forward, and you're getting through it. So thank you to all of you for your continued hard work in this course. I know this stuff isn't easy. I know that it's a lot, but I appreciate all of you and the efforts that you're making. It means a lot to me. So thank you. Thank you for that. Where are we in the class? Great question. So, believe it or not, we're already at week 5. The past 2 weeks, as you know, were a blur. So, but yeah, we're already at week 5. We made it through the midterm exam. So, a midterm exam, as you know, was due this past Sunday, along with everything before that. Pleased to report that you're all doing pretty well overall. I'm satisfied with the results that I've seen, and I think that as long as you keep up the momentum in completing all of the rest of the work on time, you'll probably pass the course. You know, uh, it- again, it's not so much that the stuff is really that difficult to grasp. Some of it, sure, absolutely, but for the most part, um, it's a matter of doing the work. Do the work, you'll pass the course. I said that first day that we met. Remember? I said, "Hey, as long as you do the work, all the work in this course, you'll pass." That's still true. It's still true. So again, if you're late with something, get it in, get it submitted. Okay, I'll still grade it. I'll still grade it. If you missed, we'll say some of the stuff from QuickBooks last week, the certifications, get it in. Get those 2 done. Well, I'll grade them. Yeah. If you're having trouble, let me know. It's important to me that you pass this course and that you are gaining the skills needed to be successful, right, in business. That's why you're here. So, again, if you need help, let me know. If you're missing any of the work, get it done, and I'll grade it. Yeah. So I've been actively making sure that I've been looking at the course every day, even while I was sick. I was still logging in, sending messages, trying to make everything still running. So uh, I again appreciate all of your efforts. Keep up the positive momentum, and let's knock the rest of this course out together, and let's finish strong. Yeah. So we're here. We are in week 5. We're about to talk about budgeting, which is probably like one of the most important concepts for any business. Because without a budget, it's very difficult to drive your business forward. So I'm going to walk you through the process of creating a master budget, and I'm also going to show you the process in the next chapter about identifying differences in the budget, called variances. So both very, very important topics. So over the next 2 hours, we're going to be talking about budgeting. I know it's not the most exciting thing in the world to talk about, but um, it's really, really important for your business, whether you're running your own business or whether you're planning on starting a business or you're a manager or planning to become a manager. You need to know this stuff. It is super critical. Even if you're running a department, you need to know budgeting. Yeah, very, very important. And some of you are going into HR. Yeah, even in HR, you need to know how to budget. So I'll walk you through all that process. Uh, so the instructional materials are there for the PowerPoint presentations. And then, of course, we have the Excel exercises. Again, they're just exercises there to help you, especially gaining those Excel skills and practicing the budgeting process. For this week, we have a discussion board and we have a hypothesis. Yeah, I know it's a lot of work. So really, there's four things you need to do for this week. One of them is a discussion board. Another one is a hypothesis. And yes, I made sure that it works this time, I think. Let's just make sure. Yes, it works. Okay, good. So the hypothesis, the discussion board, and then you, of course, you have two quizzes, right? A quiz for each chapter. So start early and work often. Okay, start early and work often. That way you're not scrambling on Sunday night. I don't want you to scramble. Okay. So the discussion board, try to knock that out on Thursday. Okay, Thursday, knock out the discussion board. And then throughout the rest of the week, knock out the hypothesis and the two quizzes. That should set you up for success. Okay. That's my recommendation for the week. And without further ado, let's jump into our discussion today on budgeting. So there's two chapters we're going to cover today, and they're both on budgeting. And I'm going to try my absolute best to explain everything in a logical way. I'll try some examples and all that good stuff. And as always, if you have questions, you go ahead and unmute your microphone, ask your question, or type it into the chat, whatever you prefer. Okay? So let's do this. So, budgeting. There's a reason why we budget. The reason why we have a personal budget at home for things like rent, food, utilities, groceries, clothing, all of those things, transportation. We typically try to have a budget for ourselves. And if you don't, you really should think about doing it. Okay? Budget for yourself. Every month I write down my budget, what I'm going to spend on each of those items. And the reason why I do that is because at the end of the month, I don't want to wonder where all my money went. I want to know where it went. Okay? The reason why we budget in business and in personal life is to give your money direction. You tell it where to go. You tell it what to do. Okay? That's why we budget. There's a process for this. We call it budgeting process. The first thing we do is, of course, develop that budget. So what is a budget and how do we develop it? A budget is a formal statement that the company plans in dollars. Fancy term. Okay, budgeting is the process of planning for the future. Budgeting is the process of planning for the future, business actions, and expressing them as a formal plan. The same principle applies in your personal life. You create a personal budget to plan for the future. Expressed in action. You're telling the dollars where to go, okay, and what to do. That's why we budget. So, first thing we do is we create a budget. How do we do that? We start by listing out our planned sales, income. Okay, we start everything with sales. We plan how much we're going to sell, or in your personal life, how much you plan on bringing in. Okay, the income side of things. In business, we start with the sales budget. Okay, how much are we going to sell? At what price? Then we start planning all of our expenses. Well, there are expenses related to selling, as you know. Every item I produce, I have direct materials, direct labor, factory overhead. I got to budget those things. to tell me how much it's going to cost to make this stuff that I'm selling, right? So super, super important, the budgeting process. Once I've planned out my expenses, I can budget for all of the other things related to that, right? Having a budget for each step of the process, very, very important. So the first thing we do is we develop that budget. Then we execute. Okay, we start working. As the revenue, sales, expenses are coming in, I'm comparing those actual to the budget. Okay, am I over or under? And I do that for each line item. Okay. The reason why we do that is because we need to control the process. Budgetary control process is management's use of budgets to see if the planned objectives are being met. If I said I'm going to sell X number of units and receive X amount of dollars, I need to see if that's true. Okay, that's my planned objective, is to make those sales. If I don't meet my objective, then I need to take action and adjust and set new plans. And it's a cycle. We do this every single year, sometimes every single month, depending on the business, of course. We do the same thing at home, right? We take our planned income, map out all of our expenses, and we should be comparing the actual expenses to the planned expenses. Same with the income. Yeah? And we take action accordingly. Same process applies. So, what are the benefits of budgeting? Budget is a plan for the future, so it helps us to identify future opportunities and threats. We control our budget. The budget helps us to provide benchmarks for evaluating the company's performance. If I said I'm going to sell X amount of dollars and X number of units, and I don't, or I do, or I exceed it, I have a benchmark, established. Same with the expenses. I said I'm going to spend this much on each line item. Did I or didn't I? And what is the difference, right? The control. A budget helps me to coordinate the activities of our employees. Okay. For example, if I say I'm going to sell X number of units, I need to produce those number of units to be sold, right? Which means I need to plan for direct labor. I need to plan for my employees. The budget also helps me to communicate to management specific action plans. Yeah, it gives direction. And a budget also helps to motivate employees, especially sales employees, when they're looking at a budget and we say, hey, sales employees, this is how much you need to sell this month. That provides motivation. Also provides motivation to employees to make sure they don't overspend. Yeah. So budgets can be motivating. These are all benefits of budgeting. Throughout this course, and if you've taken personal finance already, or maybe you haven't, or maybe you're interested in it, you'll notice that budgeting is very human behavioral. Yeah. Human behavior is at the root of business, and it's also at the root of finance. Human behavior drives 80% of all financial decision making. Yeah. 20% of finance is book knowledge, knowing formulas and stuff like that. The rest of it is human behavior. It drives it. So, budgets could be both a great thing or a bad thing, depending on how humans behave when they budget. It can be positive because it helps you to set goals that are both challenging, but yet you can attain them. It helps employees to prepare, and it offers opportunities to explain the differences between the actual and budgeted performance. So those are good things. But unfortunately, budgeting can also lead to negative human behavior. For example, a budget can provide an opportunity for an employee to act unethically or commit fraud. It's like, oh, that we add a little extra to the budget. They won't notice if part of that goes missing. Yeah, it's a possibility. This next one makes me upset. Employees might understate sales budgets and overstate expenses to allow for a cushion. You might be asking, well, Dr. B, why don't you like that? Having a cushion's sometimes a good thing. No, it's not. Here's why I don't like cushions. And we call it padding. You padded the budget. Padding simply means that you're allowing for some wiggle room in the budget. You're allowing for some, slush fund, whatever's. Not a good thing. The reason why overstating your expenses and understating your sales is bad is because it doesn't allow for any type of growth. It also makes it too easy to hit your targets. If you're like, oh, well, I expect to sell 10,000 units, and then you go and sell 20,000 units, you understated your sales goal. And that doesn't make you look good. It makes you wonder what happened, yeah? The same with expenses. You overstate your expenses. Oh, my electric bill is going to be $1,000 this month. Ends up being $200. So what about that 800 that didn't get spent? Okay, it doesn't just go to the bottom line. So that's why I don't like number 2 a lot. And the third negative outcome is employees might spend budgets unnecessarily on items to ensure that the budget is not reduced the next year. The government is notorious for doing this. Okay, number 3 really makes me upset because governments do this all the time. So you may have heard of the golden toilet in where the hell was that? In Afghanistan. So what happened was the defense budget at the time, this was quite some time ago, the defense budget was real high, and so the people running the defense department at the time were like, oh, we have to spend all this money, otherwise we're not going to get the same amount next year. That's what governments do. So they go and spend it on the most ridiculous things that are so overly inflated in price just so they can get the same amount next year. It defrauds the taxpayers, really. But companies do the same thing, okay? Defense contractors, they're really bad about doing this. Other businesses do this. It's not good. It's not a good practice. So, both positive and negative things about budgeting. The things to be aware of, especially in your own field. Yeah. Let's talk about budget reporting and timing. Budgets are continuous. We never stop budgeting. Personally, for me, I love a rolling budget. A rolling budget means that I plan for the 12 months. For let's say, right now I'm planning for 2024. Okay, so I start with January, end with December, and I got my entire year mapped out for my budget. Okay, great. Now here we are in November 2024. I'm sorry, 2023. So I got next year already mapped out. That's great. I have 12 months of budget mapped out in front of me. That's where I need to be. Now, when January 2024 ends, the first thing I do is I create the budget for January 2025. When February 2024 ends, I'm creating the budget for February 2025. When March 2024 ends, I'm creating the budget for March 2025. I always have a continuous 12 months of budget in front of me. You see, it's continuous. I always have 12 months of budget in front of me. We call that a rolling budget. It's a very common practice for businesses to use, and most of them do this. And of course, as time passes, we revise the budget. So, like, for example, if my electric bill in January 2024 ends up being 20% higher than I had budgeted for, you better believe I'm going to adjust the budget in January 2025 for that electric to be 20% higher. You see what I'm saying? So that's how continuous budgeting works. Now, throughout this course, we've been talking about manufacturing. The reason for that, of course, is so you can understand how cost works. The same principle applies in budgeting. So I want you to get into the mind of a manufacturer. Manufacturer, as you know, is somebody who makes products. Earlier, a few weeks ago, I gave an example of an auto manufacturer. Okay, Toyota, General Motors, whoever. Okay, so let's say we're an auto manufacturer. We produce cars and trucks and whatever. So we manufacture vehicles. Okay, when I manufacture a vehicle, I need to know how many units of that vehicle I'm going to sell. Right? That tells me how many units I need to make. It also helps me to plan for things like direct materials, direct labor, and factory overhead. And it also allows me to plan for other related budgets. So we go through what's called the master budgeting process. Now, I'm going to give you an example from my personal life when I was a financial controller for Radisson Hotels. Long time ago, yeah. I was working in the hotel business. One thing that I had to do every single quarter, basically, is I had to get all of the managers together for each department. Food and beverage director, the front of house, front office. I had to get the rooms division manager, who took care of housekeeping and all of the operations of the building, really. Sales manager, what am I missing? Restaurant manager, engineering department, human resources, and accounting. I had to get all 8 managers together every 3 months, lock them in a conference room, and have them provide me with their quarterly budgets. Okay, yeah, it was a challenge. Each department had to plan their own budget. I gave them what the sales were going to be, and they had to give me their expenses. Okay? And they had to map out exactly what they were going to spend, how much they were going to spend on each line item for their department. And then I would put them all together. I'd take all 8 budgets and combine them into what we called a master budget. That master budget was for the entire hotel. Okay. And I would send it up to corporate office. They would do whatever with it, send it back. But that was the part of the master budgeting process. For those of you who work in a large organization, maybe you've already experienced this or something like this. Somebody asks you, "Hey, what's the budget for your department?" In management, that's the way it works. Okay, so this is something you'll come across. Maybe not necessarily in a manufacturing setting, but this even in a service business like a hotel, you'll come across this. So that's why I tell you my personal story, because I want to make it as relatable to you as I can. So looking at it from a manufacturing perspective, say we're an automobile manufacturer. Okay, the first thing we need to do is plan for how many units, in terms of units and sales dollars, we're going to sell. Okay. Oh, we figured out the demand. There's a couple ways we figure this out. We look at the demand for the vehicle, the price point. We look at the market conditions. We look at our competitors, and we determine how many units we're going to sell for the year. Okay. So we decided, hey, you know what? We're going to sell, I don't know, just a whole bunch. Okay. 1,000 units, and which will bring us in, I don't know, $3 million, roughly. Okay, so great. Now we have our sales budget in terms of units and dollars. Then we produce what's called the production budget. As you recall, to make any product, we need direct materials, direct labor, and factory overhead. So, based off of the number of units I expect to sell, I can plan for production. So, the number of units, I figure out how much direct materials I need to produce 100,000 cars. Okay, 100,000 cars. How much materials I need? I need steel, aluminum, rubber, glass, engine components, etc. Yeah. How much of all of those things do I need to purchase? I create my direct materials budget based off of the quantity times the purchase price for each item. Okay. Add those up all together, and I get my direct materials budget total. Great. Then I need to figure out, based off of the 100,000 cars I'm producing, somebody's got to make it. I got to plan the direct labor budget. The way I do that is I take the dollar per hour wage, multiply that by the number of hours required to produce 100,000 cars. That gets me my total direct labor budget. Awesome, but we're not done yet, because the third cost of making a product is factory overhead. So factory overhead, as you recall, are things like supervisor salaries, the rent for the building, depreciation for the equipment, utilities, etc. Okay? All that's factory overhead. So what I do typically is just like we talked about when we were doing process costing and job costing, remember? We apply what's called a single wide rate method, which is usually expressed as a percentage of something like an activity base, direct labor hours, for example. Okay, 160% of direct labor, or whatever, something like that. That's usually the method, something along those lines. And that way I can budget my factory overhead. Now, once I've produced my direct materials budget, direct labor budget, factory overhead budget, combine those into what we call the production budget, then I can create what's called my cash budget. How much cash do I need in order to buy the direct materials, pay the employees, and pay all the bills? Okay. The sales budget also helps to create two additional budgets. One's called capital expenditures, and the other is called selling and administrative expenses. The capital expenditures, as you recall, the definition of capital expenditures is the purchase of property, plant, and equipment in order to expand the business. Also includes major repairs, etc. Capital expenditures. That's money set aside for purchasing property, plant, and equipment, expanding the business, or replacing equipment, whatever. Capital expenditure. So the sales budget provides me with an opportunity to set some money aside for capital expenditures, which goes into the cash budget ultimately. The sales budget also tells me my selling expenses, like paying commissions to my salespeople and shipping the product, and general and administrative expenses, supervisor salaries, payroll, the back office, etc. All that goes into the cash budget. So together, all these things together, we call this the master budget. These are all components of the master budget. Here's an example of a master budget balance sheet. In this example, we have a company that produces hockey sticks, and we're based in Toronto. So our business is producing hockey sticks to sell during the winter season when playing hockey. Okay. So here we have the balance sheet at the end of September. We have our assets, liabilities, and equity. That's what a balance sheet shows us. And so this gives us an idea of what we have on hand. I want you to pay particular attention to a couple things here. The cash, $20,000, end of September. Our accounts receivable, $25,200. We currently have some raw materials inventory, 178 pounds of wood, $20 per pound. That's our cost, yeah? $3,560 worth. We also have finished hockey sticks sitting in our finished goods inventory. We have 1,010 hockey sticks completed and available, ready for sale. That were produced, so this would be cost of goods sold, $17 per hockey stick, valued at $17,170. Okay, those are the important things I want you to try to keep in mind as we go through the next few examples, as we go through the master budgeting process. We have this information. Now let's go through the master budgeting process. So everything starts with the sales budget. The sales budget is what drives the budgeting process. The number of units I expect to sell for each month throughout the year. In this example, we'll do it by quarter, just to keep this simple. So here we have an example. Our company manufactures and sells hockey sticks. Here we have the next 3 months. Remember, we just looked at the balance sheet for the end of September. And I expect to sell the following throughout the next 3 months. Okay. We sold in the month of September, we sold 700 hockey sticks for $60 a piece. That's the sale price. Yeah. Remember, it costs us $17 a piece to make. So here's what we got. Here are my next 3 months of projected sales. The month of October, I expect to sell 1,000 units. Sale price of $60 a piece. Total sales budget for October, $60,000. For November, I'm going to sell 800 units. In December, I'm going to sell 1,400 units. For the 3 months, I plan to sell 3,200 units at $60 a piece. My total sales I'll bring in for the quarter is $192,000. Okay, great information. Now, take that information and I move on in the master budgeting process to the production budget. The production budget tells me how many units I expect to produce, to make, based off of the sales projections. I'm going to sell, what I say, 1,300 units. Yeah, no, I'm sorry. I'm going to sell 3,200 units, okay, over the next 3 months. And so based off of that information in my balance sheet, I need to figure out how many units I need to make, okay? So here's how this works. Here's the formula for it. The number of units we need to produce throughout the next 3 months is based off of the budgeted ending inventory plus the budgeted sales units minus the beginning finished goods inventory in units. Okay. I kind of already know these numbers. All right. We expect to sell 3,200 units, right, based off of the previous slide. So budgeted sales units is 3,200. My beginning finished goods inventory was back on our balance sheet from September, remember? Finished goods inventory is 1,010 units. Okay, so minus 1,010 units. 3,200 minus 1,010. But then I might also have some budgeted ending inventory units. Remember, budgeted ending inventory units is the amount of units I want to have at the end of the month or at the end of the period. So let's take a look at the next slide and figure this out for each month. So here we have the information. For the month of October, I said I was going to sell 1,000 units. Based off of that, I need to figure out how many units I need to produce. Well, based off of the formula, I take the budgeted ending inventory in units plus the number of units to be sold minus ending inventory. So budgeted sales units is 1,000. The next period budget units is 800. Now, how we got 800? We got 800 based off of the next period budgeted sales. I'm going to sell 800 units in November. Okay. The reason why I'm adding this 800 is because I need to make sure I have 800 units ready for the beginning of the month of November. Got to have them on hand. You know? I take that and I multiply by 90%, which is the ratio of the inventory of future sales. Ratio of the inventory of future sales is used to provide us with the next month's budgeted sales for the beginning inventory. Okay. In other words, that's how many units are going to be left over at the end of October. Is 720. desired ending inventory. So I got my 720 plus the 1,000 that I plan to sell. Gives me the total required units for the month of October. Minus the beginning inventory balance based off of the balance sheet that we saw for September, which is 1,010 units. That means I need to produce 710 units for the month of October. Okay, got October figured out. And it's part of November because I know what the beginning inventory is going to look like for the month of November. Month of November, I said I was going to sell 800 units. Plus the next month, which is 1,400 times the 90%. So 1,400 times the 90% is 1,260, which is the beginning balance for the month of December. I need 800 plus the 1,260 gets me total required units for the month of November, 2,060. Minus the beginning balance, which of course came from the prior month, 720. Gets me units to produce 1,340. And then I go through the same process for December. Make sense? Are there any questions on this part? I know this is probably a little bit more difficult to understand, so I just want to make sure that you're all okay in grasping this part of the concept. Are we doing okay? Yeah? All right. Just making sure now, because I know that this part's probably a little bit more challenging. Okay, cool. Let's keep rolling. So, this is our production budget. Now that I have my production budget set, how many units I'm producing each month, now I could start to figure out direct materials, direct labor, and factory overhead budgets. Okay. Remember, the sales budget drives the process. Sales budget tells me how many units I need to produce. Production budget. Production budget derives direct materials, direct labor, and factory overhead to produce the number of units we said we were going to produce in the production budget. Okay, so that's where we are in the process, master budgeting process. So, direct materials. I got to figure out how many materials I need to purchase for direct materials. How much wood in this business do I need to purchase? To find out the number of units I need to purchase, how much pounds of wood, I take the number of units I'm going to produce from the production budget times the materials required per unit. How much wood per unit is needed per hockey stick, yeah? Plus desired ending inventory for raw materials minus the beginning raw materials inventory balance from the month of September in this example. So that last part's going to be found on our balance sheet from September. So let's draw out the direct materials budget. There's a couple of steps here. 5 steps for the direct materials budget. Direct materials budget shows us how much materials I need to purchase, raw materials I need to purchase for each month. Okay? That's how we figure it out. Step 1 is identifying the number of units we need to produce. We got that from the sales budget, remember? After we drew out the sales budget. And the production budget for units for each month. Step 2, multiply that amount by the number of units I need to produce each unit. So, how much raw materials per unit? It takes half a pound of wood to produce 1 hockey stick. So I take number of units times half a pound of wood for each hockey stick. For the month of October, that gets me to 355 pounds I need in order to produce these 710 hockey sticks. Then I add in the desired ending materials inventory. To find the desired ending materials inventory, I find that to be half the amount of wood required to produce the following month's need. Okay. So in this example, in the month of November, I need 670 pounds. So half of that is 335. Okay. So I add 355 plus 350, 335 gets me to 690 pounds of wood I need for the month of October. Minus the beginning balance inventory, which we found on our balance sheet from the month of September, 178 pounds. Equals 512 pounds of wood I need to purchase in the month of October. The purchase price per pound of wood is $20. So 512 times the $20 is $10,240 of wood I need to purchase for the month of October. I follow that same exact process for every single month. So follow the 5 steps. Number of units times amount needed per unit. Equals the materials needed for production plus desired ending inventory, which is half the previous month, half the next month, equals total units required minus beginning materials inventory equals materials needed to purchase. Multiply that by the purchase price to find the total cost for that month. That is the direct materials budget. Very, very straightforward. It's relatively easy to follow as long as you follow the steps. Okay, now that we figured out how much wood we need to purchase for each month, the next thing we need to figure out is who's going to make it? How many employees do I need? How many hours is it going to take? This will help us to find the cost of direct labor to produce. Okay? Here's the formula. Very straightforward, very easy. So the number of units I need to produce, which we got from the production budget, times the direct labor hours required per unit. How long does it take to produce one hockey stick? Example, 0.25 of an hour, quarter of an hour, okay? Also known as 15 minutes, times direct labor cost per hour. That's it. Very, very straightforward. Let me show you what it looks like. October, we need to produce 710 units. It takes 15 minutes, which is a quarter of an hour, to produce one hockey stick. So 710 units times 0.25, quarter of an hour, also known as 15 minutes, equals direct labor hours needed for the month. And for October, it's 177.5 hours. Multiply that amount by the hourly wage, $12 an hour, equals the cost of direct labor, $2,130 for the month of October. It's only 3 steps. Number of units to produce times the amount of time it takes per unit equals direct labor hours needed I'll multiply that by the hourly wage to find the cost of direct labor. That's it. Very straightforward. You don't have to worry about, oh, this goes in that month, this goes, no. Very straightforward. That's direct labor. Nice and easy. And then, of course, we figured out direct materials, we figured out direct labor. Now we got to figure out the factory overhead. The factory overhead, as I had mentioned, is relatively easy to compute. Okay, it depends on the method that the company is using, but in our example, we're going to try to keep it as easy as possible. We use a single plant-wide rate method. Okay, and it's based off of the variable overhead rate per direct labor hour. Okay, that's how we figure it out. So here we have the example. We got October, November, and December. The first thing we need to do is figure out the variable overhead. Then we figure out the fixed overhead, and then we add those two together. Very, very straightforward. Okay. For the fixed overhead, it's $1,500 a month. Easy. What's usually included in fixed overhead, you might be asking? It would be rent, depreciation expense, and any other fixed costs associated with overhead. Okay. Easiest way is to take total overhead and divide that by the number of months. Simple. That's fixed. Variable is a little bit more difficult. Assign what's called a variable rate. The variable rate in this case is $2.50 per unit. How do we find the variable rate, you might be asking? Well, of course, it's found by looking at the variable components in manufacturing. Direct materials and direct labor are usually mostly fixed, but variable rate, of course, is the other unit of production, as you know. Okay, so $2.50 per unit. Awesome. Now that we know that information, we take the direct labor hours needed found from the direct labor budget. This example, 177.5 hours from the month of October. We multiply that by $10 of variable overhead rate per direct labor hour. That's the factory applied rate. Equals the budgeted variable overhead, in this case, $1,775. I add that to my fixed budget of $1,500 for the month to get total factory overhead for the month of October, $3,275. Follow that same exact process for every month. Pretty straightforward for the most part. Any questions on direct materials, direct labor, or factory overhead budgets? We doing okay? Honestly, in my opinion, it's the most confusing part. So I just want to make sure. Awesome, thank you. All right, cool. So we figured out the sales budget, the production budget, direct materials, direct labor, and factory overhead budgets. Now we figured all those things out, we need to budget out our income statement, balance sheet. In order to get the cash budget, which of course we also need to find the capital expenditures budget and the selling administrative expenses budget. So let's walk through those. First is the product cost per unit budget. Okay. This tells us that we use this to find the cost of goods sold, right? Product cost per unit. Helps us to find the cost of goods sold budget, which helps us to budget the income statement. So here's what we do. We take direct materials per unit. In this example, $10 per unit. How we got that? It's $20 per pound of materials times half a pound per hockey stick is $10. Direct labor per unit takes 15 minutes to create one hockey stick, 0.25 an hour. Times hourly rate, $12, is $3 per unit. We take the variable factory overhead, which is direct labor per hour, 0.25, which is 15 minutes, times the $10 variable overhead rate per hour. Gives us a total variable overhead per unit of $2.50. We have our fixed costs, $1,500 a month. We divide that by the number of units expected to be produced per month. In this example, 1,000 units. This is $1.50 fixed overhead per unit. We add direct materials plus direct labor plus variable and fixed overheads per unit to find $17 of total cost per unit. So $17 per unit. If I'm going to sell 1,000 units in the month of October, I multiply that by $17 per unit to get a cost of goods sold of $17,000. Yeah, I do that same process for each month. So budgeted sales, number of units, yeah, times cost per unit. That gives you budgeted cost of goods sold. Yeah, helps you to budget the income statement. Relatively straightforward. I need to budget my selling and administrative expenses. So how do we do that? We take the budgeted sales dollars, which we got from the sales budget, multiply that by the commission rate, find the sales commissions. I then add in any fixed sales expenses like salaries for managers to equal the total selling expense budget for that month. Same process applies for each month. Yeah, very straightforward. Budgeted sales dollars times commission rate equals sales commissions plus fixed salaries equals total selling expense. Yeah, very straightforward. Then I find my administrative expenses. This example really straightforward. General administrative salaries, $54,000, which is $4,500 per month. Yeah, you just take the total amount, divide by 12. Administrative expenses, very easy. Okay, I got my selling administrative expenses. Now I need to look at preparing the cash budget. But before I do that, I have to prepare my capital expenditures budget. This is when I decide to purchase property, plant, equipment. Helps me to budget for that process. In this case, the month of December, I plan to purchase a piece of machinery for $25,000. Simple. Straightforward. So we just put that in the budget. Now I can budget for my cash. The cash budget formula, a little complicated, but not terrible. Okay. Here's how it works. We take the beginning cash balance that we got from the balance sheet. Remember, I think it was like $20,000 in our example. Plus the budgeted cash receipts. That part gets a little complicated. I'm going to show you what that looks like. Because not all customers pay cash. Some of them purchase on accounts receivable. So I need to account for the receipt of those receivables in the future. So I'll show you what this looks like. Minus budgeted cash payments. Obviously got to pay expenses, yeah? Equals the preliminary cash balance. If this is above the minimum requirement, I can use that extra cash to do things like repay loans or to invest. If it's below the minimum requirement, I might need to take out a loan, short-term. And that gets me to my ending cash balance. This part was the part that I said was a little bit more difficult, budgeting for cash receipts. Okay. As I had mentioned, not all customers pay with cash. In our example, 40% of my customers do. I mean, 60% don't. They pay on credit. So 40% of all my expected sales are going to come from cash. The rest of it is going to be collected later. Okay. So the month of September, I made $42,000 in sales. Why is that number important? Because 60% of that I'm going to collect in cash in the month of October. All right. The month of October, I made $60,000 in sales. 40% of that I'm collecting cash up front, so 24,000, which is 40% of 60. Then I'm going to add that to my collection from the prior period. Remember, all of my sales I make, 60% of them are on accounts receivable. So they pay me the next month. September I sold 42,000 times 60% is 25,200. 25,200 plus the 24,000. Month of October I expect to receive $49,200 in cash from my customers. I follow that same exact process for every single month. That helps me to budget for the cash receipts. Okay. So, I follow that budgeting process, expect 60% to be collected the following month, plus 40% to be collected that month, gets me total cash receipts for each month. Right? Kind of gives you an idea. It's important to know when you're getting cash because it helps you to plan for the operations of the business. It also helps you to do things like purchase direct materials in order to get the business going. Some materials purchases. I budgeted the cash amount for materials purchases for each month based off of the number of units I expect to produce for that month, remember? So it gives me an idea of how much cash I need to pay for those purchases, direct materials. It also helps me to budget for things like direct labor. Obviously, my employees need to get paid every month, so I need to budget for that. Also budget for variable overhead, sales commissions, sales salaries. See, you can see that this cash budget drives the budget for the income statement and the balance sheet. Of course, any remaining cash I have left over, I can pay loans off. Or if I need to take out a loan, I can do that too. Here's what the budgeted financial statements look like. So here we have a budgeted income statement, amount of sales expect to sell minus cost of goods sold budget equals the budgeted gross profit minus my selling and administrative expenses minus my sales tax equals net income. And of course, I could budget for the balance sheet just as the process started with. And as I had mentioned earlier on, using my personal example from the hotel business, you can do the same process for budgeting for service companies. Yeah. Like a law firm or a dentist or a hotel, etc. So it's important to also note, with a service business, there's no direct materials, there's no factory overhead. So, but we do have direct labor. So, on direct labor budget, it's real simple with a service business. It's a budget direct labor hours times the cost per hour or labor per hour. I could break this down to be revenue per employee. This shows us how much revenue is expected for each employee to generate over time. And the way we figure this out is we take the total revenue divided by the total employees. And this just kind of walks you through the process. If you're like a merchandise business, you're not going to have direct materials, direct labor, factory overhead, but you will have purchases because you need to purchase your inventory that you're going to sell. So purchases would be part of the budgeting process. And to figure out how many units you need to purchase in your retail business, we take budgeted sales plus desired ending inventory minus beginning balance inventory. Very straightforward. So we follow that process for purchases. Okay, my friends, we made it to the end of our discussion on the master budgeting process. Any questions so far on budgeting you can think of? Any questions so far? Or are we doing okay? You all still awake? I know
No,
this is
we're
a
doing
boring
good.
topic. Okay.
Yeah. Well, it's a question for after class. Talk to you personally. Is that okay with you?
Yeah, of course it is. You know
All
that.
right. Thank you.
Absolutely. My pleasure. Okay. All right. Given that, let's go ahead. We'll stop this part of the recording and then I'll start the next one. We're still focusing on budgeting, but we're going to shift gears just a little bit and talk about how we're comparing the budget to the actual performance. We're going to talk about what we call variances. So please stand by for that conversation.